Howdy YouTube, welcome back to Crooked Concepts. Today we're going to be covering some of the most underappreciated opportunities in this market, some that have been beaten down into the mud and have potentially great upside, amazing brands, moats for days, and cash that seems endless. So if you enjoy these kinds of videos, please like, subscribe, and here's a picture of a cute monkey as a thank you. So this environment is based around hype. Nobody's paying attention to anything beaten down. And that means we should target the beaten down stocks aggressively right now. The two that I'm targeting are being mispriced because of inflation cycles, and I think they could explode as soon as interest rates fall a little bit, which during the next midterm and Jerome Powell stepping down, I believe in March, I think it's right around the corner. I'm going to reveal at the end what those two are, but before I do, let's further paint the entire environment that's flipping in their favor quietly. So, this chart is from the Federal Reserve. It shows what happens to returns on capital in a low interest rate environment over pretty much a 40-year time span. So this chart here breaks down the net contributions of the S&P 500 within a similar time span. It also breaks it down over here by sector, which you can see that tech is currently making up the largest portion. But right here, R&D is what is actually eating into our net contribution margins. So people are trying to innovate right now and spending more on innovation than any time really in history. Next, we have another study that covers the effects of what happens when rates actually fall. One of the effects is consumer discretionary spending increases. That just means that people like me and you are able to go out and get money for cheaper, and therefore we spend more of it when rates are lower. Another thing is growth stocks. They call it technology here, but growth companies are able to demand a higher valuation simply because money is cheaper to fund the growth. Real estate is also encouraged quite a bit because it's easier for home buyers, especially first time home buyers and refinancers, to go out and get a lower mortgage. So you're encouraged to actually refinance. And industrials, they usually benefit from an increase in government spending and project development. There's more studies done on this that explain how when interest rates drop, it doesn't just help companies survive, it actually helps both price and margin expansion, along with real organic growth. So, pretty much being the summarization that companies that look horrible right now, the ones that have temporary crush margins, they've been ugly for years, they have expensive capex cycles and investor fatigue. Those are the exact setups that reverse the hardest in this kind of environment. The first candidate is the strongest apparel brand in the world, recognized globally, Nike, priced like it's dying, down 52% on a 5-year chart. Now, Nike's margins have gotten shredded by supply chain rebuilds. They have an inventory bloat and a once in a lifetime inflation spike. But the recovery is already happening under new management. They're having cheaper freights, they're having better inventory casting, massive automation, they're having AI driven design and logistics, they're having China exposure decreasing, and margin acceleration has already started. You can see that in their latest quarter here. More than that, they're being priced like they were in 2018, yet their revenue has grown nearly 50% since then. They're being priced like they're dying. And the second stock I'm buying right now is ticker FBIN, or Fortune Brands Innovation. This is the most ignored winner in the entire home sector. Everyone thinks housing is dead right now, but FBN isn't about building the houses. They're about selling stuff inside the houses. I'm talking Moat faucets, your shower valves, smart water systems to help detect leaks, your security tech like your Yale, your door, your cabinets, all your hardware. And here's the key. The average American home right now is hitting this remodeling age, this sweet spot. Demand was not destroyed by those high rates. It was just delayed. So when rates fall, the delayed demand comes roaring back, and FBIN has a nice dividend that pays me while I wait. So right now, I think it's a good time to not chase hype. Instead, focus on companies that have compressed margins that you can see expanding in this new environment we're going into. Look for companies that are hated or ignored. Those are the ones I think we should target the most aggressively, especially when this environment flips. They are going to reap the most benefits. That's all I have for this video. Until next time.